anything related to open-to-buy requirements, order cycle times, purchase orders, anything related to the financials around inventory carrying costs, or for that matter, working capital, or any other related inventory, the inventory records such as cycle counts or low balance inventory audits, shelf level audits. All this information is stored in a centralized environment. It is available in an updated format for the supply chain, for the merchandising teams, for the overall the teams that manage inventory optimization, so that they can plan the right levels of inventory buying strategies. At the end of the day, it's all about how you procure inventory and how effectively do you procure in a way that it is optimized for your stores and for your warehouses, so that you're not overbuying or underbuying at a time when you would like to do the best business in the best possible manner in this current economic environment. So that's where I think best-in-class companies outperform others by almost a third. The other aspect, key aspect, as you can see on your screen, is the enterprise-wide visibility. I think if you take the Walmart example, Walmart effect still continues unabated in the industry, because what Walmart has done is they've applied a two or threefold strategy, right? Firstly, they've got the best technology implemented as far as having an agile retail supply chain to really make sure that the store level merchandise is as appropriate and as effectively managed as possible. Secondly, what Walmart has done, which is really interesting and which continues the Walmart effect, is that they have a agile and visible retail supply chain, and that goes to the furthest of their suppliers deep into their overall extended supply chain. And what that does is that it creates a culture in Walmart that their associates and managers, their warehouse supervisors, their extended supply chain folks have visibility towards where inventory is moving, how it is moving in the entire extended retail supply chain. And what that helps with is really identifying SKU level inventory availability. And when you create that kind of visibility, that the stores know where the warehouse has SKU availability. The warehouse knows which stores need the SKU availability or the shelf level availability as and when in real time. And all the planners and the buyers and the headquarter folks that are involved with inventory planning know exactly what to do in terms of optimizing inventory strategies. So this is where best-in-class companies are 1.5 times more likely than average and laggard companies to be able to outperform on. Now, coming towards the technology side, which is the key enablers in the base model, what we see is a number of different components that are top of mind for best-in-class retailers in terms of how they're using the technology and how they plan to use the technology. First and foremost is an inventory forecasting system. 90% of best-in-class companies, compared to 55% of all others, are currently using an inventory forecasting system. That obviously is improving their agility in terms of how they're planning their inventory, and gives them a step above all others in terms of how they look at the demand shift patterns. Secondly, order management. We just spoke about that, and that's again 65 to 47% mix in terms of how best-in-class companies are leading all others. Another couple of interesting ones are where companies in the best-in-class fold are applying vendor management inventory strategies so that they're not burdening their supply chain by not taking the help of vendors who can drop ship merchandise directly to the stores, and that really takes a lot of burden off of the shoulders of the overall retail supply chain. And then most interestingly is where we've, for the first time, according to our research, consumer-driven replenishment and consumer-driven inventory systems are now coming into play, and now we're seeing a trend even in Europe, that consumer-driven inventory systems are becoming more and more popular. And what these are is really a demand-based, shelf-level based inventory system that looks at perpetual inventory and really optimizes inventory to the shelf, makes sure that full price items can sell through as much as possible. It really is a bottoms up approach where you look at stored cluster instead of looking at the top down approach where you plan randomly on inventory through a cluster based strategy. This really looks at a more localized strategy in terms of what the stores actually need and to replenish the stores based on their shelf level needs. Now, perpetual inventory strategies that are especially consumer-driven and demand-driven show much higher performance. In one case where we found, as you can see on the graph, in terms of inventory turn rate, there's almost 1,000 basis points difference in terms of companies that have perpetual inventory, which is really consumer-driven and demand-driven, versus those that are store location-based, non-perpetual inventory strategies, which are not working really. And if you look at the outer stock cost, look at the difference. Those companies that have perpetual inventory strategies divided by cross-functional product teams are seeing much better results in reducing outer stock costs compared to companies that have non-perpetual inventory strategies that are following the traditional non-automated ordering strategies where orders are made too late. Often orders are delayed for 3-4 days or even a week. So an out of stock cost is really the lost sales opportunity cost that a retailer incurs when the product is out of stock on the shelf. So this really talks about the performance aspect of perpetual inventory. Now let's look at the segment-wise distribution, and as you can see, which segments are doing better than others in retail. As you can see, apparel is doing pretty well. Apparel and specialty lead the way as being above average performers in the retail segment when it comes to the optimization of inventory and precision merchandising techniques in the industry today, according to our results. General merchandise and grocery are lagging. Now, if you think about the general merchandise and grocery, they are also a third of general merchandise and grocery retailers that we surveyed are also in the below average performing category, whereas apparel and specialty are not that high up in terms of being below average. So obviously the real opportunity in the industry today is to help all retailers, but most importantly focus on the existing opportunities as far as general merchandise. There are opportunities with at least half of apparel retailers as well, and then you've also got the grocery segment, which needs a lot of help in terms of really taking its performance to the average level, and then after the average level to an above average level. And the reason for the lack of movement in the general merchandise and grocery categories has been the larger penetration of legacy inventory applications as well as non-perpetual inventory inventory processes that exist in both these segments. And they've been the slow movers, whereas apparel and specialty have been the fast movers as far as adopting perpetual inventory, consumer-driven replenishment, as well as demand-based replenishment for effective working capital management. Now, what the next slide really shows is a very interesting comparison between apparel, general merchandise, grocery, and the specialty segments. And by the way, this is global data, so take it in that perspective. We've looked at all key performance criterias on the left-hand column, which includes planned ROI, time to ROI, inventory turn rate, that's how fast the inventory is turning how fast the inventory is selling through in your stores year over year. Out of stock cost, like I said, is the sales opportunity cost calculated when you have an item out of stock. Customer satisfaction at the retail shelf, and this is a measure that is used by best-in-class retailers